What's going on, everybody? It's Natasha Watkins, your favorite realtor. We're back again. And this is the first show for 2024. And welcome. We're a little bit late today. We usually do it on a Monday, and today is Tuesday afternoon. But we'll see you guys next Monday, and we'll be right on time for the Monday market report or the state of the market. I'm sorry, Monday market report. It's Friday market report. It is what it is. Welcome back again. Like I said, happy 2024. Today is going to be an interesting day. We're going to talk a little bit about affordability. What does that look like going from 2023 into 2024? Is it going to look a little bit better for 2024? We're hoping so. We know we've already started to see a little bit of a pullback on those interest rates. I want to say as of today, we're about 6.25. It could be a little bit off, but it's around that period. It's low sixes, depending on your lender, maybe even high fives, just depending on your deal. And remember, we always have options, kind of like the 3-2-1 buy down, different things like that to buy down the rates. Which, I was having a conversation with a good friend of mine, and just thinking about where we came from 2023 until where we are now. Buying down the rates may not be the best deal, but we will go through all of that. So let's get right into it. What we're talking about today is affordability, and what's that going to look like? Like I said, is 2024 going to be a little bit more affordable for buyers? And are we still going to see good numbers for sellers? So let's get right into it. This right here is a great chart for us to go over. This is mortgage payment to income ratio. And what does that mean? That means in terms of how much money you make and how much that mortgage takes up of the amount of money that you make. When we look at this chart is assuming that it's a 30-year fixed mortgage with 20% down, and that you're the median income price for the country. Remember, this is nationwide as well, and also the median income. So this is payment to income ratio. Okay. So when we look at 2020, we're seeing that we're around that time period, the average American with the median income, 19.6% of that income they're using towards their mortgage. We see that increase, and we know what's going on at this particular period in time, what's going on with the banks. We don't even need to go into that, but we're seeing a little bit of increase. And when we get to 2006, it's about 24.7% of people's income that's going towards that mortgage. We know what's going to go on as we hit 2007 into 2008. As we know, we can't. One of the reasons why we like to go back and look at these numbers, that we don't have a crystal ball to let us know what's going to happen in 2024. The way that we project what's going to happen in 2024 is that when we look at the trends of numbers. So what we see happens in 2006, we start to see that fall off. We know what's about to happen in 2008, and in 2008 we're going to see that crash, and that's where we see this huge drop, because there's a ton of inventory of homes, a lot of foreclosure that's going to happen. And this is what people was going to predict was going to happen in 2023. And from the end of 2022 going into 2023, we saw a lot of people pull back off the market, because we saw those huge increases in interest rates. But what people did not take into consideration was this. What people did not take into consideration was this: is what happened at that particular time and point was there was no inventory. And inventory, it's the supply and demand. Inventory dictated what was going on. And we'll go into a little bit about that once we go into another one of the slides. But we did not see that huge fall off. Like, people was predicting that it was going to be another crash like 2008, and prices was going to go down, and people held off. And the opposite actually happened. We saw an increase. We didn't really see a huge increase. What we saw was a little bit of stabilization in property prices, and I think we saw a minor increase. So what you could have gotten at 2000 and early 2003, by the middle of the year, we're seeing a little bit of increase in that. And I want to see what happens in Q4 when we look at those Q4 numbers and see where we were towards the beginning of the year and towards the end. like I always say, everything is a lagging indicator because we're about 60 to 90 days behind from when a home goes under contract to when the home closes. So we got to keep that in mind as well. So let's take a look at the next chart. Now, this one is pretty interesting. This is percent changed in home prices. This is since Q1 of 1991 to Q3 of 2023. Again, lagging indicators, we haven't gotten numbers for 2024 yet. But this is interesting because what this shows is the amount of equity that we've gotten in people's home over the last couple of years. This goes back from 1991. Remember, we saw at the end of that period, everyone was like, the real estate market is going to crash. But another thing that people did not keep in mind was this, is that at this particular time and point, people had a ton of equity in their home. And that's what this chart is going to show. It's going to show how much equity people had in their home. So even if they had a tough time, when we look at this chart, what does that mean? Is that they could tap into that equity. So when we look at the Pacific region, we saw from 1991 to 2003, and who really benefit from this was the baby boomers, the ones who bought back then. They're in a sweet spot, because they have so much equity in their home. So if you bought back in 1991, you saw about a 351% increase in home prices from 1991 to 2023. So that's a lot of equity, you know. It's a good time to be a baby boomer. Us Generation X, if you purchase, we did pretty well as well. But that's why they say home is one of the keys to wealth. So they have quite a bit of equity in their home. When we look at the mountain regions, they saw the biggest increase from 1991 to 2023, which is 475.6, increase. The national average across the country is 306%. That's from 1991 to 2023. So I want you guys to keep that in mind. Especially if you're a homeowner that bought around this particular time and point, you have options, even though that the interest rates are a lot higher. You have so much equity in your home, your home is appreciated so much that if you are one of those people where you need a little bit more room, the family has grown since 1991, or you need a less room in terms of the kids are already out of the house, or they've already been married, they've already have their own kids, just depending on when you purchase, and you're thinking, after this pandemic, one of the things that I really, really want is to be a little bit closer to the family. This is a great opportunity for you to make that move, because what you can do is you can tap into that little bit of equity that you have in that home, and you can put a large down payment on something smaller. We had, after this pandemic, I know my mom didn't see my daughter as much as she would like to, because we shut down, and we're trying to get out to Connecticut a little bit more so my mom can visit and everything like that. That's neither here and there. But if you're in that situation where you're like, look, I want to be closer to the family, but I don't know with these interest rates. Forget the interest rate, do the math, connect with the mortgage lender, and see what that math looks like for you. You know, can I put down a huge sum of money and offset that mortgage payment even at this 6%? I maybe, if I'm downsiding it, I may even come out with a less mortgage payment than I am. It's tough because 2 to 3%, but in line where would I have or pay a little bit more because I've paid down so much. I have so much equity in my home at this particular time and point. So you always got to work the numbers, and the numbers is what makes the most sense to people. Forget about what the prices are, forget what the interest rate is. Look at it from a non-emotional standpoint and look at what those numbers are saying. Average numbers of offers received, the most recent closes. So this is going back to 2018. What this is the average amount of offers received per home on an average across the country. So this is trying to say, like, look, 2018, the average offers on a home, and it could be more, it could be less, depending on your market, depending on what inventory looks like, depending on how often people are moving. So this depends on your area and everything like that. So there's different circumstances, So remember, this is a country, this is a nationwide number. In 2018, we saw 2.1 offers on home. We saw a little bit of dip in 2019 and 2020. What's happening in 2020? A couple of things are happening in 2020 at this particular time and point. The first thing that's happening in 2020 is this, that we are entering the pandemic and things are shutting down. People need more space. And a lot of people are working remotely at this particular time and point, 2020, 2021. And what also is happening in this particular time and point, if you're lucky enough to be able to still be able to afford it and still be able to keep it and working at the particular time and point, is this. What's happening at the particular point and point is that it's low inventory in the market. Everybody needs space, and it's being very, very, very competitive. So as we look at those numbers in 2020, we see that the number of offers, the average numbers of offers, and remember, this is nationwide, so depending on the market, it's less or more for you. It's about 3.4 offers per home. That means that it's very, very, very competitive in this market at this particular time and point. That's 2020 and 2021. We're seeing a huge amount of offers. And there's one more thing that's happening. Not only the pandemic is happening at this particular time and point, but the other thing that's going on is that the inventory is low. And that was even in like 2019, we saw low inventory. I don't think it's going to go back to where everybody's out at work full time, where, we're going to see, everybody goes back to work. I know in my household, my wife, she works remotely. I know a lot of the clients that I'm talking to is that they're in the office 3 days and they're out of the office 2 days. So they're working from home 2 days a week, just depending on who you are. I think that's the standard going forward. I think for right now, most people, they're going to work out of the office 3 days and then 2 days in home. So a home office is becoming a lot more important to people. So there's always going to be that competition, especially in New York area where we're at. Is there's always going to be a competition right now for that home office and for that extra space. Good news for people as well is that we got to look at this at two folds. What's also going to go on, in my opinion, is that the baby boomers, hopefully they've noticed that they've had all this equity in their home, and they're going to want to make the move. They're going to want to make the move to warmer weather. And I've had a couple of clients in 2023 who just wanted to make the move. They have all this equity in their home and they have that opportunity, whether it's going to Florida where the taxes is better, whatever it is. That's a good news for us, for buyers right now. It's an opportunity for you to get out there before the interest rates come down. I don't think we're going to see 2 to 3% interest rates again. Where I think we're going to be at this particular time and point is we're going to see about 5% interest rates. That's what we're predicting coming into 2004, the mid of 2004. All the loan officers that I've talked to, they're predicting this huge refinance boom where, people have these 8%, these 6%, these 7% interest rates, and they've luckily enough got into a home. Now, all they have to do is make sure that the home that they got into was affordable and they can make those monthly payments. And that's what's most important to a lot of our clients out there is the fact that they are able to have a home that's affordable. And that's what we look at whenever we do an analysis on a client that's buying his home. It's just make sure those numbers make sense for you, because we want to make sure that when you purchase a home, you're not struggling. So don't purchase a home to purchase a home. Make sure you look at those numbers and it's affordable. And that's what today's life is all about, the affordability in the home. If you guys ever need, we do this free analysis for all of our clients where we break down what the numbers and what the monthly payment looks like. We could do one of those for you guys. Just reach out and let us know. So let's get right back into it. Again, offers 3.4, 3.7, 2022. It's good news for buyers. We're seeing a return. We're still a little bit higher than the average of 2018, but we're 2.4, 2.5 in terms of where we're at in terms of offers to the home. Okay. All right. So let's move on to the next slide. This one is one that I love. And if you guys watched our Friday show, Every Friday, we do days on the market and we show you what's going on in Nassau, Queens, and Suffolk County. We tell you what the days on the market is. We tell you if prices are going up or prices are going down. Don't miss that show on Fridays. Every Friday, we're gonna hit you guys with those numbers. So 2017, what's going on right now from 2017? This is medium days on market. So what this means, let's break this down. This means that what this means right here is this. This means from the point in time of which you put a home on the market. So we have a home that's going live this Saturday. We put it on the market yesterday as of today's Tuesday. As of Monday, we started marketing. It's hit the MLS and everything like that. From that particular time to when they get the keys to those homes, that's days on market. That's how long. And he wants you to, sorry, until they go under contract, not when they get the keys. I apologize about that. Until they sign that particular contract, from when we put it on market until they sign a contract, this is the days on market. This is how many days it takes a home to actually sell and be under contract. 60 to 90 days afterwards, that's when you're going to get your keys, depending on whether or not you are financing or if you're paying all cash or whatever the case is. So let's get back to this chart. In 2017, the average days on market was 68 days. When we come into 2020 and 2021, the average days on market is 20 days. So we saw a huge decrease in days on market, which that shows you that even over the pandemic, we were still transacting. We go into 2022 and 2023 where people were predicting that there was going to be this huge crash, and the average days on market was a little less than 2020. It went to 50. And that's the average days on market over the whole year of 2023. There's just not enough inventory out there. And I want you guys to keep that in mind, is that when we're looking for a home right now, I want you to keep in mind that we're still low in inventory. The interest rates are coming down now. We're in the winter market right now, and it's not as competitive as summer, spring. So this is actually still a good time for you to be out there looking for a home. I have a couple of clients that we're taking out this weekend to look for a home, and I'm not just saying that because I'm a real estate agent. I'm saying this was in terms of when we look at the numbers and when we look at the trends of what's going on in the market right now. 2022, 2023, we saw the average days in the market. We didn't see that decrease. We looked at the numbers in terms of average home price. We know people are still buying at these high interest rates. I'm out there in the field. I'm up against 2 to 3 to 4 offers. You know, so I don't see this changing. I see when we go into the mid of 2024 and we hit that summer spring market, what I'm predicting is going to happen is that we're going to see we're going to see it tighten up a little bit because we're going to have a lot more people that are able to afford homes in this period. So take a look at the market. The most important thing is that monthly payment, and I want you guys to keep that in mind. The most important thing when buying a home is that monthly payment. What is that going to look like? Can I afford to do the same things that I do now if I buy this home? This is Atasha Watkins, your favorite realtor. I'll see you guys next Monday for another State of the Market. I'm out of here. Peace.